Hello, everyone. My name is Sayaba Okumboa. I'm here on the marketing team at Armanino. Thank you for joining us today for a Fireside chat about the One Big Beautiful Bill that just passed in July and what it means for the future of professional services. So first, we're going to do some housekeeping. Make sure to use the Q&A box below, some time for questions at the end. So anything that you need to know, make sure to use the chat function below. We have some upcoming events, as well as the 2025 annual law firm and compensation benefits survey. It is out now. We've extended the deadline to August 31st. So there is still time to participate. There is still time to buy. So you can find the link on our website, and we'll make sure to send it out in the post-event email as well. And we'll also have a webinar on AI for professional services firms on August 20th. So be on the lookout for that as well. And just what you can kind of expect today, we'll be describing the key provisions of the One Big Beautiful Bill. We'll explain how those tax changes may impact your business or your personal situation, and then how you can be strategic and define year-end actions to help position yourself the best for this year and the new upcoming year too. And with that, I will introduce today's presenters. We'll go ahead and start with Kelsey, who's a director here at Armanino. Kelsey, please go ahead and introduce yourself.
Thanks, Sayaba. As Sayaba mentioned, I am a director here at Armanino in our consulting business unit. I work in business outsourcing services where we provide accounting, finance, HR, and payroll support to professional service companies. And I'm also on our professional services leadership team here at the firm. So I'm here today to kind of offer a non-tax perspective and ask the questions that I think a lot of you have. But yeah, excited to speak with you all today.
Thanks, Kelsey. Olga, go ahead and let you introduce yourself.
Yeah, thank you. Olga Bleiweiss. I'm a tax partner here at Armanino in the professional or privately held business group. I'm also the tax market leader in the Philadelphia office, and I'm one of the industry leaders of professional services.
Thanks, Olga. And Kelvin, you will round us out.
Hello, everybody. My name is Kelvin So, tax partner out of our Southern California offices, one of the Southern California market leaders for professional service firms in California. And I have a little special niche for film production, film distribution type companies as well, but I'm also part of the privately held business group. I know there's a lot to talk about for this super simple bill that was recently passed, so I think we should just jump right into it.
Thanks, Kelvin. And I'll go ahead and turn it over to Kelsey, who will be moderating today's Fireside chat.
So the goal of today is that this is not a lecture on tax law, but we want it to be as interactive and as conversational as possible. So if you have questions, throw them in the chat, throw them in the Q&A section. We will answer all of them, and we will try to really break this down in a tangible human way for you. So first up, I'm just going to give a quick general overview on the Big Beautiful Bill. So this was passed on July 4th of this year. There was a lot of anticipation as to when it was going to be passed and what the bill would actually include. So it covers four main areas. So the first is it modified the spending for federal programs. Second, it implements a lot of structural reforms for agencies and other programs to align more with the current administration's policies. The third thing it does is it raises the debt ceiling. And the last thing, which is why we're all here today, is it extends and implements a lot of tax changes. So there's some tax provisions from prior bills and acts that are being extended, and then some new ones that are being implemented. So today we're going to get into all of those tax changes. We're going to start with how it impacts you as a business, and then we'll get into how it impacts individuals. So first up, we'll talk business. So there's a lot of things that this new bill covers. So the first thing, Kelvin, let's talk a little bit about bonus depreciation. First of all, what is that and how does that impact the business owners here today?
Thanks, Kelsey. So bonus depreciation is almost everybody's best friend whenever they hear that when it comes to the Big Beautiful Bill Act. I think for many people who've been doing this for a while, they've heard about bonus depreciation being about 50% in the past. And then once the TCJA was adopted, and I think Kelsey corrected me on this, but just to be clear, Tax Cuts and Jobs Act of 2017 was when President Trump first came into the White House and passed his big first bill. He basically set a bonus depreciation rule of 100% up to, I believe, around 2022. And then after that, every year after that, it started to phase out. It's supposed to be ending around the end of 2026. So if you guys have heard of this before, you've been hearing about 100%. And then a couple of years ago, 80, and then 60. And 2025 was supposed to be 40. But with the passage of the Big Beautiful Bill Act, this has permanently restored 100% bonus depreciation for qualifying assets placed in service after January 19, 2025. Very, very interesting part of the law, right? Very specific date. When the president came in, I think he wants to be thanked for all of this depreciation that he's about to give everybody. So how does it impact a lot of the professional service firms? Businesses that need to be doing a lot of like telephone updates, computer, internet, system, furniture. If you're moving to different spaces, qualified leasehold improvement, long as it's not structural. All of that stuff is now essentially 100% deductible from a federal tax perspective. As a California boy, it's a different conversation for California, but that is for federal purposes. This is definitely a very nice tool to have in your back pocket when it comes to tax planning on trying to make sure that you either reduce your taxable income as much as possible or trying to find ways to match your income and expenses. Okay. Quickly, just a real life example. A couple of clients have been calling me these days about, hey, we want to go through this big implementation, fixed asset, capital improvement, right? Do we buy our computer system or computers? Do we lease it? Do we go on a monthly payment plan? Or do we find a way to take a loan against it, right? What's the best way? And I think all of my team members will agree. I always say it depends. It really depends on your firm and the way that your business is currently running. Today, the world is at such an uncertain place when it comes to the economy. So it really depends on, is your firm thriving? Do you have the cash flow? Are you concerned about the upcoming economy? Are you impacted by your tariffs because your clients aren't impacted? A lot of this conversation needs to be had to properly plan. But to go back to my example, some people would say, if I want to do $100,000 implementation, what happens if I just pay it all upfront with cash? Then that's essentially $100,000 deduction in year one. You're out of pocket of cash of $100,000, and then there's no more deduction in future years. Or if you have cash flow issues, sometimes lease payments may make more sense. You know the budgets of each monthly payment. You take those deductions as you go. That could be helpful for planning purposes. And last but not least, some people say, what if I take a loan out? I say, whenever a loan comes in, definitely talk to your CPA because it can result in phantom income. And what that means is essentially, if $100,000 is the implementation and you guys pay $60,000 up front and take a loan of $40,000, no matter how much the loan is, you're taking the deduction in year one unless you elect out of bonus depreciation anyways. So if that's the case, you guys might be happy in year one, taking all that deduction. But in year two, when income continues to come in and you pay your loan down, those aren't deductions. Those are income that being allocated to your partners with no cash. So a lot of things to be thinking about from a planning perspective. Quickly about 179, it's just another tool in your toolbox. It increases our 179 cap to an inflation adjusted amount of 2.5 million. There is a special provision about qualified manufacturing production facilities, very specific for other clients. So maybe your clients may be impacted, but I don't think it's going to be impactful for the audience today.
So Kelvin, given this change, this is a strategy that business owners can use at the end of the year to lower their taxable income, right? Is what you're saying? Because now it's 100%.
It's 100% unless you elect out. So it's part of the conversation of and I believe bonus depreciation is all or nothing. So if you elect out for the year, you don't get the bonus and then you go back to your 5-year, 7-year, 15-year depreciation. But if you guys feel like you guys have the income to offset it, why not? But I understand every firm has different wants and needs. So I think it's definitely worth the conversation, but make sure those fixed assets are nice and tidy because it's very helpful when it comes to that.
Yeah. And Kelvin, just to add to this is also a great planning opportunity with cost segregation studies, right? Where if you are doing a heavy capital investment, you may want to look to do a cost seg study to accelerate some of the assets that perhaps would qualify as 39-year property into 15-year leasehold improvements to accelerate bonus depreciation.
You're 100% right, Olga. And I think the one thing is, I know this is professional service related, but we all have real estate friends. And I think the real estate industry is something that be impacted like severely when it comes to this, because cost segregation, people always talk about the present, but nobody ever thinks about going back and doing cost seg. And that's an option as well. So if you know anybody who is in that situation, I think we definitely have some good cost segregation experts on our side that can help with that. So it's definitely worth to bring to the next Labor Day barbecue, because it's definitely something that's pretty valuable.
Awesome. Okay, one of the other changes for businesses is all about research and development credits. So, Olga, can you explain a little bit what those are and how it impacts professional service firms?
Absolutely. So back in TCJA, there was a rule that was created for any kind of R&D expenses, which also includes 174 costs. It required a capitalization and amortization. So just to clarify, I know our audience here is really not manufacturing anything, but 174 applies to professional services firms. If your firm is building a level of technology, it qualifies for immediate expense, or at least it used to. And then TCJA required capitalization and amortization over 5 years, which was very punitive to our clients. So again, to clarify, this would really be software that is proprietary. This is not software that you would buy that's canned, that's readily available on the market, but really unique to you and your organization. What is great is that this bill permanently restores the immediate expenses of these costs. So, of course, as with every bill, things are a little bit complex. So I will try and streamline some of these rules. For what we call small business taxpayers, and that's defined as gross receipts on average of $31 million or below for tax years 22 through 24, you have the ability to go back and amend prior year returns and expense those costs rather than amortizing them. What's interesting here is that we have yet to receive guidance for the unfiled 2024 tax returns. So presumably the way that the law is written, you actually have to file a return and then go back and amend the return. So we're hoping, given that the filing deadline isn't until September 15th, we're hopeful that there may be some guidance issued. But if not, we absolutely have the opportunity to go back and amend those returns. For other taxpayers who don't meet that gross receipts test, they will have the ability to write off the 174 costs in 2025 or spread it between 2025 and 2026. So again, great result for professional services firms, great result for taxpayers in general. The foreign R&D piece remains unchanged. That is still required to be capitalized and amortized over 15 years. And again, we're hoping to get more guidance soon on this particular provision.
Yeah, and Olga, sorry, quickly add, I think I know a lot of firms these days are always asking about AI, right? We had the big AI webinar a couple of weeks ago. We had another one coming up. And then everybody's talking about, hey, I'm doing ChatGPT Enterprise or Teams Enterprise or a handful of all the other new AI things that we've been doing. That's essentially off the shelf. Okay, so just want to just be very mindful of that, where it's such a simple vocabulary word, but it's very different when it comes to the actual tax implementation or implication.
Absolutely. And we also have a team here at Armanino who can go in and just evaluate whether or not your software rises to the level where it would be deductible under 174. Certainly something you want to approach with your CPA or your extended team. And of course, we're happy to lend a hand as well.
Awesome. Okay, the next big change for businesses is all about qualified business income deductions. So, Kelvin, can you talk a little bit about what this is and what the change is for businesses?
This topic is the one that always gives me the biggest headache. Just because if anybody's ever tried to look through an example of how this is computed, it is almost as if I would say equivalent to one of those SAT questions where they ask about the lesser or greater and what's bigger and what's smaller to come up with an amount just for this 20% deduction that we're all trying to get. So QBI, Section 199A is what some people call it. Qualified Business Income Deduction is what most people know it as. The initial, the QBI. The TCJA implemented this rule. The QBI deduction was designed to allow sole proprietors and owners of pass-through entities to basically take a deduction of up to 20% of their income on their personal return from that business. Why? Many people said that this was put into place because there was too big of a discrepancy between the personal highest income tax rate of 37% versus the C corporation's rate of 21%. So the government said, hey, here's 20%. What does that do? It brings down the potential max effective tax rate to closer to around 29.6% if years are eligible to take the deduction. But how the Big Beautiful Bill Act impacted this specific provision? It makes 199A permanent now. We thought this was temporary. We did not know it was going to last past 2026, but it is permanent and it's here to stay. The biggest thing is a majority of the audience here is going to fall into something called specific trade or businesses, which people will call it as SSTBs. For some odd reason, they called out these service professionals and said, hey, you're going to be held to stricter guidelines when it comes to income threshold. So once you pass the income threshold, you guys don't get to participate or receive the deduction anymore. For all other businesses who are QBI qualified or eligible, after they phase out of the income threshold, there's a whole different computation they can get regarding 50% of wages or 2.5% or 25% of wages plus 2.5% of all the fixed assets you put in over the last 10 years. A whole complete different computation. But for majority of the audience people here, I think the most important thing is to notice on the slide about those phase out ranges. Okay. For sole proprietors, for people who are running the S Corps or receiving K1 from law firms, Olga will talk about the line one discrepancy difference later. But I think it's important to know that if you're in this SSTB bucket, which is specific trades or businesses or service professionals, just be mindful. If you're around the 494,600 or next year 544,000, you may be on this borderline of saying, is there any tax planning opportunities to get it below that amount to receive this deduction? Can we find a way to put more into retirement to get you there? Is there a way to take bonus depreciation to help get you there? Are there other ways to find ways to reduce the taxable incomes just so you're able to qualify for this deduction? Because we definitely don't want to leave money on the table. So a couple other things about the Big Beautiful Bill Act. There's a new floor that provides minimum deductions of $400 for taxpayers who have at least $1,000 of QBI. And I think the most important thing to take out of this big slide is SSTBs. The Big Beautiful Bill Act basically gave you a little bit more cushion and relief, but still not a, fair, I would say, compared to the qualified business income taxpayers.
So, Kelvin, we actually have a question. Is it personal income or business income for the different phases you're talking about?
The different phases is all from the personal income perspective. Once the business income for the flow-throughs flow up to you, the K1 will most likely say, are you QBI or SSTB? It should be clear on the K1. You take that information, report it on your personal return, do the full algebraic equation I talked about, and then determine if you can receive the benefit or not. Okay. But a lot of you guys should know, if you're in the service industry, professional services field, you're most likely SSTB. Okay. So just want to put that, but to answer the question, it's more personal perspective.
And Kelvin, this is AGI phase outs, correct?
Yes, I believe it's AGI phase out.
Yeah.
One of those.
And so couple of planning points, right? Brought up retirement plans. So what tends to be pretty popular with law firms are cash balance plans. That's a real great opportunity for law firms and other professional services firms to move a significant amount towards retirement and it's essentially your cash, right? And that might help you get into these phase out buckets. But another planning opportunity is to really look at your partnership agreement. And as Kelvin alluded to, the SSTB rules really apply to line 1 income. Line 4 which is the guaranteed payment bucket. If you're in the if you're getting a guaranteed payment out of your firm, that does not qualify for QBI, but line 1 income does. So a planning opportunity might be, well, could you allocate a portion of the income to line 1 versus line 4? And of course, that would depend on how your partnership agreement is structured and whether or not you truly are receiving guaranteed payments, irrespective of profits of the firm. But again, something you might want to revisit with the firm leaders and the management committee, and then also review your partnership agreement to see whether or not adjustments could be made so that more partners could fall into these brackets and not get phased out of the deduction.
Right. So the last thing on the business side before we get into the individual side is all about interest limitations. So Olga, can you tell us how the interest limitations have changed with this new bill?
Absolutely. So again, TCJA introduced this concept and code section of 163J, which limits or limited the amount of deductible interest expense for certain taxpayers. And in the past, the computation was 30% of EBITDA. And over time, EBITDA became EBIT. So they dropped the depreciation and amortization add back, which significantly lowered the amount of interest expense that a firm could deduct. This restores permanently the depreciation and amortization add back starting December 31st, 2024, which is great for tax year 2025. So again, planning opportunities where perhaps in the past you were not able to deduct all the interest expense, you may be more inclined to go out and borrow now that that interest is deductible and won't be carried over. Where we are looking for perhaps some additional guidance is if you were in a situation where you had carryover interest, and for some of you who may have experienced that, that number gets tracked personally, and it's, again, very complicated. But with this new rule, would it allow for excess income for it to release prior carryovers? Again, something we're going to be looking towards, but hopefully that will allow for some of the old interest expense that may have been suspended and carried over to get triggered as a deduction.
So the last thing I'm just going to mention on the business side, a lot of professional service firms work with contractors or consultants that are paid via 1099. So another change with this bill is that the 1099 reporting threshold changed. So what used to be $600 is now $2,000. So for anyone working with contractors or different consultants, I still recommend collecting the W-9 before you send them any money. But for 1099 reporting purposes, you will only need to report, starting with the tax year of 2026, anything $2,000 and above. So that's my little consulting anecdote for you all. So let's get into how this impacts individuals. So there's obviously everything we talked about on the business side. There's a ton of ground that we're going to cover also on the individual side. So right here, we have a lot of the main categories listed that we're going to talk about. We're going to talk about the pass-through entity tax, the tax bracket changes, personal exemptions, deductions, all of that. But first, let's start with the state and local tax deduction. So Kelvin, do you want to get into that for us?
Yeah, no, I think like I mentioned earlier, as a California resident, this was a very, very big deal for a lot of us. I think back in when the TCJA was implemented back in 2017, I think it was December 22nd, where it started as of January 1st, that they set a state and local tax deduction cap of $10,000. And I think a lot of you guys have heard of this already. 10,000 is inclusive of all of your state taxes, your property taxes, and those even small DMV fees. So 10,000 for these coastal states were definitely not enough. Okay. So when they first did this, they thought it was kind of like a target for those coastal states with high income tax brackets. But then what we realized was a lot of our states started to get a little bit creative. And they said, what if we create this little pass-through entity tax loophole for each individual state and try to run through this deduction through the entity instead? So the entity will pay the tax on behalf of the partner or shareholder. The entity will receive the benefit of the deduction, and we'll pass all of that, including the credit, to the partner or shareholder. And to be honest with you, a lot of us at that time were all like, there's no way this is going to be blessed by the IRS. The whole point was to set us a cap anyways. But somehow, some way, it did get blessed. And when that happened, all the other states started to tap into this. I think there might be about 30 to 34 states now with their own PTET rules. So as you guys can tell, this is very, very complicated. But before we jump into that, the reason why this was very important was the $10,000 cap we talked about. Due to the Big Beautiful Bill Act, the adult limitation raised to $40,000 now, okay, for married filing joint couples, $20,000 for married filing separate filers, beginning in 2025 and through tax year 2029. So this is the retroactive to this year to $40,000. You guys might have heard over the past couple of months about all of the back and forth between the House and the Senate going through about the caps, but they got it through at 40,000, which is not perfect, but something, right? The cap increases by 1% each year after 2025 for inflation. The only biggest caveat is 40,000 sounds good until you make over 500,000. Then when you make over 500,000, they have this limitation where it gets phased down by 30% of the excess of your modified AGI to bring your state tax deduction back to 10,000. So basically, if you made 600,000, you're back at $10,000 of a state tax cap, which is not fun, but this leads to the next slide of the pass-through entity tax. So this portion is actually a big conversation that was had between the House and Senate over the past couple months. And to be honest with you, even us CPAs were a little bit nervous because we were all being caught up in this little whirlwind. Are we going to get it or not? Because the House initially proposed that they were going to strike out the PTET for professional service firm. We were all a little bit nervous, but there must have been somebody in the Senate that had our back because somehow, some way, it got removed. And it got removed so the PTET is here to stay, okay? So this is going to be important as long as your states conform and continue to release guidance that they are willing to have these elections and programs available for their taxpayers. But the reason we want to talk about the pass-through entity tax, and I'm just going to talk about it from a California perspective, is this is such a huge benefit, especially if we just start using numbers like people who make more than this 500, 600,000 amount, right? If somebody makes about, let's just say $1 million for simplicity's sake, and California allows you to take a 9.3% deduction on that. That is easily $90,000 of deduction that is available to you that you would have lost if you were capped at 10,000. This net swing of 80,000 multiplied it by, I don't know, let's just assume 30% for now for a tax rate. You're probably saving over $24,000 just from participating in this. So even though these numbers are flying everywhere, our job is to make sure we don't leave this kind of money on the table, okay? But we need to make sure that you're structured correctly. So for all your sole proprietors who are still reporting on Schedule C, you have to call somebody. The sole shareholders, the partnerships, we have to find ways to be able to utilize this because if you live in a high income tax state, this is a huge benefit that we cannot leave off the table, okay? But for everybody who has been doing this for a couple of years now, this is not easy. It's a very complex ordeal. California forces you to have make your election by June 15th every year, either paying $1,000, the greater of $1,000, or 50% of last year. So how does that impact all of you? Now you guys have to try to take money from your partner's distributions to withhold it. Or do your firms decide to prepay all of the money for the partners? And then how does this all get chewed up on the back end of the year end? And at year end, are we trying to accelerate as much deductions as possible by asking you to make a second payment? So I just want to say that the PTET is still pretty darn complicated, but I would highly encourage, especially if you're in these high income states, to definitely reach out to have these conversations. One last caveat is with the 40,000 increase now, the people who are making 300,000, 400,000, the PTET may not be as beneficial anymore because you are about to come back to this weird spot where $40,000, I'll just take it. So I just want to say with state taxes is a very important part with these individual provisions, but the PTET plays a huge role still for a lot of professional service firms.
Yeah, and sorry, Kelsey, I just want to chime in for East Coast, right? I'm in the Philadelphia area. Pennsylvania is one of those states that is, on a horse and buggy chugging along to the current times. We still do not have the technical correction, which would allow for partnerships to claim a credit for PTET participation in other states. And so last I checked, there was a bill in legislation somewhere. I am hopeful now that the PTET had no changes that states like Pennsylvania will get through the legislative portion of it. But states like New York, New Jersey, they all have their own rules. And again, to Kelvin's point, the timing of the elections are important. The amount that you need to pay from a cash flow. Where does the overpayment go? Does it go to the partnership? Does it go to the partners? How do you account for that? These are all planning opportunities that we highly advise you discuss with your accounting team.
One question that we got, didn't California pass legislature for this year to give an extension at a reduced cap?
In regards to the PTET?
I believe so, yeah, in regards to PTET.
So all I could say is the PTET is still available, especially for this 2025 tax year. And from our understanding, at least with California, there may be temporary, but which I'll take a quick look into, but we don't expect this to be taken away from California, especially we know how much it impacts the taxpayers. In regards to the $40,000 deduction, it is implemented for federal purposes since 2025. But for this tax year, 2025, PTET is still available for taxpayers.
Sorry, one point of clarification. If you missed the 6/15 deadline, I think that's what we're asking, if that is extended. Sorry.
Yes, no. So you have to be careful with this because yes, if you missed the 6/15 deadline, you do have something new in your back pocket, but that's be very specific. We have the Los Angeles taxpayer wildfire disaster relief. Okay. You could benefit from this extension if your entity or yourself is located in the Los Angeles County address, or if your CPA is located in Los Angeles County as well. So as long as you fit into these two buckets, you are allowed to extend the payment to October 15th. This is a one-time thing. Don't make it a habit. 6/15 needs to be in everybody's brains because if we miss it by $1, you can't participate. So you're right. 10/15 is the extension this year just due to the wildfires we had in January, but it is not the norm.
So, okay. We're going to talk for 3 more minutes and then we're going to take questions from you all. So if you have any other questions, put them in the chat, put them in the Q&A box, please, and we will get to them. So last up, Olga, can you just talk about some additional provisions that have to do with this new bill?
Absolutely. So one big planning opportunity at the individual level has to do with charitable giving. So you can see some of the new provisions, and I'll focus more on the individual than the corporate. The bill created a % floor for charitable contributions and also created a cap for taxpayers in the 37% tax bracket. And so effectively, you would be phased out at 2% of your giving plus a 0.5% floor. And so if you're a high income taxpayer with an AGI over $1 million, that 0.5% floor can be very impactful. When I was having a conversation with my client yesterday, I said, think of it like the 7.5% floor for medical expenses, which, nobody tends to be able to deduct unless you have, heaven forbid, a pretty bad catastrophic year with out-of-pocket medical costs. So some tax planning that can be done here is looking at a donor advised fund where you can front load contributions and get a current year benefit in 2025, which would then not be limited by these new provisions. You don't have to actually disperse out of the donor advised fund in the current year. You could just fund it, get the charitable contribution. And even if you can't utilize the whole amount for any particular reason, you still have that 5-year carry forward that would apply. So that might be a great planning opportunity. Of course, we always advise direct contribution of appreciated stock versus selling it and then donating the cash. You can always put appreciated stock in a donor advised fund. And then another good planning opportunity, if any of you, I know we might have some of councils here, if anyone is starting with minimum distributions out of their retirement accounts, making that a direct contribution to a charitable organization, you basically circumvent some of these limitations because it is a direct contribution out. And so that's something else you might want to discuss with your CPA and your financial advisor. Kelsey,
Yeah. Let's go to the next slide and just quickly cover the new bracket.
Yeah. So here we just wanted to make sure that as a takeaway, you all had this information. This just shows the adjustments to each particular tax bracket where the rates fall out. I just want to highlight one thing for our high income taxpayers. One of the big things that Trump talked about was elimination of the marriage penalty. And you can see that all across the bracket between single filers and married filing joint up till the 35% tax bracket. However, after that, you are definitely in a marriage penalty because you can see that your 37% rate is not double the single filer rate. So I just wanted to point that out as well.
Perfect. Okay. Any questions, please throw them into the Q&A or the chat and we can answer them.
And as we're waiting for the Q&A, just wanted to quickly add, California did extend the PTET program to 2030. So we're in it for another 5 years. So just wanted to update everybody on that front.
Yeah, it'll be very interesting to see what the states do because as our slide reflected, the $40,000 cap sunsets in 2029. And I think, by that time we'll have a different administration one way or the other. And so yet again, we should expect a new tax bill in a few years when some of these provisions are either going to sunset or go away. There are also a lot more provisions to this bill having to do with estate planning and other tax areas. We really tried to cherry pick the sections that we thought would be most applicable for this audience in professional service firms. But please know there's a lot more detail to this bill. And of course, Armanino is hosting a number of different webcasts, and we're certainly open to having conversations on your specific tax strategies and portfolio.
Yeah.
So we have one last question, that I'll ask you all. In your opinion, what is the most impactful part of this bill? I lied. We're going to have 2 questions. Which individually, what do you think is the most impactful part?
For me, the most impactful part is the SALT cap. The silent item here is the reinstatement of the AMT. And so what historically has not been an issue these last number of years, because state and local taxes were the biggest preference item for most people, it's going to be interesting to see how this shakes out for AMT tax purposes, right? So when you're doing your year-end projections, when you're looking at your whole tax situation, I think AMT is going to start playing a larger role than it has in the last 5 years.
Yeah, just not to want to repeat, but I think the state tax cap was important. You guys noticed that in the news, some Senate, I think House representatives saying, "I'm not voting a certain way until this gets fixed." So it was a big deal when it comes to going through this legislation. But I do think bonus appreciation is definitely a big one. And if it doesn't fully impact all of our professional service firms, I'm telling you, it's impactful for like rental real estate, all of the real estate side, literally anything and everything when it comes to fixed assets or capital improvement. Being able to take 100% back up front instead of 40% this year or 20% next year, I think is definitely something that I think is very valuable. One quick comment though, the minute details of this bill was absolutely ridiculous. Okay. There's something about this. There was somebody lost a battle in Congress about employer provided meals, coffee, snacks. Those are supposedly non-deductible as of 2026. So whoever fought for that lost that one. The tips, the overtime, the mortgage interest. I think somebody asked about that, right? It's now permanently at 750,000. So a lot of things we haven't got into it, but I do believe that if you guys have any questions that are very specific, I would definitely advise you guys to just reach out.
Last question. You all talked about there will be other tax changes as provisions expire. Someone asked, what will happen if the Democrats win the House in 2026? Will that impact the tax laws? And then what happens as well if the Democrats win the White House in 2028? How would that impact this big, beautiful bill?
So I would say I don't expect there to be any changes to the current law, the one big beautiful bill. We have never seen in history a reversal of an existing tax bill. What's interesting too is that the last bill, TCJA, was revenue neutral because most short-term bills have to be in order to pass. This one raised the debt ceiling, which was also interesting. So if I were to bet with my crystal ball, I would say no changes to the big, beautiful bill, but I would absolutely expect a new tax bill when there's a new president, probably in the first year to 2 years of the term.
Yeah, and I know that it sounds crazy, but we talked about how even for state taxes, that the coastal states want it all back. But I think in reality, even when the Democrats did have control early on the previous 4 years, nothing was done on the front. People still wanted their money at the end of the day. So similar to Olga, I'm not expecting it, but I do, with everybody's different interests, I do think things might change. Clean energy credits might be a lot more easier to get, things like that. But I do believe that for this one, I don't think nothing's going to change in 26. Maybe 28, but then that's the whole another 4 years after that.
Well, thank you all so much for attending today. We appreciate you joining. If anyone has any specific questions, feel free to email. We will be sending out the slides and the recording. Olga and Kelvin's emails are here. If you guys have specific questions, please don't hesitate to reach out. We appreciate you joining, and we will talk to you all soon. Thank you.
Thanks, everybody.
Thank you.